Live Wednesday for February 1st, 2023. We're back. We were off last week. In fact, we took a lot of days off in January, so hopefully we'll get back at it again a little bit more consistently. With me again, America's favorite credit expert, John Ulzheimer, formerly with FICO and Equifax. All right, we are back. So, John, we'll see what happens tonight. We had about so the way that we do our lives is everybody who enrolled in Credit Versio within a week from the last time, actually not last live. Oh yeah, in our case it's the last live. So we'll probably have an invitation for about 1,500 people or so that enrolled since we did our last live. So we'll see what happens. I think I think because we're giving out real facts and real information and coaching. We don't have like an intro of us standing by a safe with looking surprised like we just cracked some code or found some secret dispute strategy or something that has never been seen before. So maybe we're not getting quite we're not the viral sensation that we probably should be. So anyway, but nonetheless, here we are teaching people about how credit works and how credit scores work. And John, always great to have you on the live with me.
Yeah, thank you for having me as always.
So I didn't prompt you for today's live because we're going to talk about a subject that's pretty old hat, but the larger we get, the more this comes up. So I thought it would be, as it always is, relevant to our live, which is talking about the title that I came up with is "What is your real credit score?" And because we get a lot of questions, a lot of posts on Facebook. How come my scores are different than what I'm seeing on Experian? And how come my scores are different than what my bank app gave me? And how come my score dropped 60 points from where it was 2 weeks ago? So I mean, these are very kind of very normal, very normal concerns. So I thought we'd go back to basics and let's talk about why we don't have, or let me just I'll put the ball in your court. How come we have so many credit scores? Do we have one credit score? And if we do, where is it? How do we find it? So let's go back to basics. Let's talk about credit scores, how they work, and why there's so many of them.
Yeah, and what whenever we talk about credit scores, we always talk about, I'd really like to get my credit score above 800. And really, we almost we talk about it as a singular thing, right? My credit score, and that's partially, my fault and everyone who writes about credit scores' fault because we always talk about here's the strategy to improve your credit score. If you pay your bills on time, you'll have a better credit score. So
Yeah.
we kind of feed into this issue. But if we had, as everyone who's watching is about to find out, if we had to fully explain this every single time we wrote about anything having to do with credit scores, we'd spend 50% of an article explaining the backstory of why you had so many scores, and the other 50% of the article actually getting to the point of the article. So
Right.
you certainly, first off, and I always go back to the grocery store as my comparison because it's, in my mind, it's the best comparison I can think of. When you go to the grocery store, if you go down the cereal aisle or the soft drink aisle, whatever aisle, the frozen food aisle, whatever aisle you want to go down. I like the cereal aisle. Everything in that aisle is called cereal, right? As you look above, there's a little sign that indicates what is in that aisle, and it says cereal. So everything is in that aisle is called cereal. But when you walk down that aisle, it's like, it's like you're walking through almost like the Charlie and the Chocolate Factory worth of different types of candies, right? There are literally dozens and dozens and dozens of different types of cereal made by a variety of different manufacturers, General Mills, Nabisco. I don't know all the brands, but you get my point. But they all have one thing in common. They're all cereal. So that's kind of like how it is with credit scores. So if you were at some sort of grocery store that sold credit scores, and if you looked above and it said credit scores, you could walk down the aisle and you'd see different brands. You'd see a different variety of credit scores, but they all have one thing in common. They're all called credit scores. So hopefully my serial comparison gave people a little bit of, oh, I didn't really think about it like that. That kind of makes sense. So pretty much every general use credit score, tri-bureau, meaning available from all three of the reporting agencies, credit score is going to fall under one of two brands, FICO and Vantage Score. So when you say, well, my FICO score is this and my Vantage score is that, you're really saying the brand of the score. You're not really identifying any particular, um, you know, flavor or type of cereal with respect to your how you're describing it. FICO, the brand FICO, has been around since the 1950s.
Mm-hmm.
The brand FICO, with respect to credit bureau scores, meaning the scores that are built for use and distribution by the credit bureaus, have been around since the late 1980s. In fact, 1989 is when FICO installed the Beacon credit scoring software at Equifax, and boom, we had our first credit bureau-based generic scoring system was called Beacon. And then a couple of years later, TRW and TransUnion got their FICO scores. TransUnion, it was called Empirica, and at TRW, it was called the TRW Fair Isaac score. And that was
now,
it.
Were you at Equifax at that time, or were you there just a little bit later?
No. I was at Equifax when TRW sold their credit services division to Bain and Associates, which then sold it to the company that Bright Universal Stores, which named their U.S. Credit Bureau subsidiary Experian. So yeah, I was there during the transition between TRW and the new company in the U.S. called Experian.
And for those just real quick watching, again, we're going to go through credit scores and how they work. But if you have any questions along the way, this is a live Q&A, so feel free to put your question up here and we'll post it. Go ahead, John.
Yeah, so kind of continuing with the history lesson with respect to credit scores. So not unlike your mobile phone, every couple of years there's a new version of the software that is designed and developed by the credit score developer and is made commercially available. Just like if you go to the Apple Store and you order a new one of these every couple of years, it's the iPhone this, the iPhone that. They're all called the iPhone, but they're definitely not the same thing. The newer versions have more bells and whistles, maybe a better camera, whatever.
Yeah.
And so that's also how it works with FICO scores. You have FICO this, FICO that, FICO V2, FICO 4, FICO 5, FICO 8, 9, 10, 10T. So you have all these different generations of scores, but they're all FICO scores. And then you have variants. And so in the old days, you had the FICO personal finance score, the FICO installment score, the FICO mortgage score, the FICO bank card score, the FICO auto score. So again, these are all FICO scores, but they are variations of the generic version of the models that were built specifically for lending in certain types of industries. And now everything I'm saying you have to multiply by 3 credit bureaus, because each of the 3 credit bureaus got their own custom developed suite of the FICO scores. FICO didn't just build one model and then give it to all the credit bureaus. They were custom developed and still are custom developed for all 3 of the credit reporting agencies independently. And that's why it's highly unlikely that your credit reports are ever going to have the same FICO score at the same time across all 3 bureaus. Number one, your credit reports are probably different, but not considerably different, but they're probably different. And number 2 is the scoring systems aren't the same across all 3 bureaus. Vantage score is a different story, which we'll get to in a minute, but FICOs are not the same. So,
and this is usually, John, a bone of contention for a lot of people. Like, let's just put up Liz's comments. This is a perfect example of what we're talking about. Came in late. That's okay, Liz. We're actually starting to get into the meat of this, but it drives me crazy that FICO is different from my actual credit score at the bureaus. Well, hold on a second here. We'll cover that one. Unless I probably never know what my real scores are. So yeah. So Liz, keep watching, because we're unfolding this. There's a lot to unpack here, but John's doing an amazing job of explaining how FICO scores work, and we'll get into Vantage in a second. But yeah, John, that's a great point. Is you've got different FICO scores on all three bureaus, and all three bureaus are separate companies, and sometimes have different information. And sometimes it's minor, sometimes it's considerable. You might have two or three collections that just show up on TransUnion because that's the only bureau they want to report on. And Experian and Equifax scores are totally different as a result. But
let me give you a great example. In the mortgage industry, at Experian, it's FICO version 2 from Experian. It's FICO 4 and 5 at TransUnion and Equifax. So again, I'm going to sound like a broken record. They're all FICO scores, but they're not the same generation of FICO scores. They
right.
don't treat things the same way. One of those three models doesn't treat inquiries the same way as the other two models. So, to Liz's point, and I'll expand on Liz's point, is even if you had identical credit reports across all the bureaus, which you don't, but even if you did, your scores wouldn't be the same because the models aren't the same. And if the models aren't the same, then it's going to gen a different score, even if the credit reports are identical. The FICO generation that has critical mass of users is FICO 8. That's 2 generations off the most current version, okay? That's like saying that the iPhone 8 has the most users, even though there are more contemporary versions of the iPhone. Obviously, in the next 18 to 24 months, the mortgage industry is going to move to VantageScore 4 and FICO 10T. So again, we're going to have a model that's used in the mortgage environment that isn't the same as the model that's being used by a critical mass of users. Right. And I want to be clear, and I'm being recorded, and so I'm quite certain that my friends from FICO are going to see this. This is not a criticism of FICO. This is not a criticism of the credit bureaus. This is not a criticism of VantageScore. This is just how it works, okay? This is what happens when you have multiple generations of a score commercially available. Lenders are going to pick and choose which one they want to buy for use in underwriting. The only industry where a model is being mandated is the mortgage industry. But outside of mortgage, auto, credit card, personal loan, whatever, none of that garbage exists. They get to pick and choose like a buffet what they want to eat, and no one tells them you have to eat that chicken, you have to eat that steak, like what happens in the mortgage environment, which is still going to happen. But at the very least, we've now transitioned to the most current version versus these ancient models that were built like two decades ago, which is what's still happening in the mortgage world. So, yeah. And then, I'm not going to mention the name of this fake finance celebrity or whatever, but then you have people coming out and crapping all over VantageScore, calling it a fake score, calling it an educational score, and that's all bullshit. But no one stands up and says that, except for I guess people like me. And so it kind of suggests that there's this plastic version of the credit score out there, kind of confusing people, and people think, oh, it's not my real score, and then you end up with kind of questions like Liz's, which is kind of insinuates that there's an actual score, like a real score, versus something else that someone may be getting from a website or from an app on a phone. The definition between a real score and a credit score that is not real is in the Equal Credit Opportunity Act. It's straight out of the ECOA. The law defines what is a credit score and what is not. A credit score is a scoring system that is empirically derived and demonstrably sound, meaning that it has to be built using approved and recognized mathematical methods, and you have to be able to demonstrate that it works. If you can't do those things, then lenders in the United States cannot use it, period. If you can do those things, then it is a quote-unquote real score because it's ECOA compliant. If it has reason codes, it's FCRA compliant, and a lender is allowed to use it. They may choose not to use it, or they may choose to use it. So,
for those who don't know, if you didn't mention it, John, the ECOA is the Equal Credit Opportunity Act, and FCRA is the Fair Credit Reporting Act, which is kind of what guides the It's kind of the legislation that dictates what bureaus have to do. And,
That's
and
right.
and I put up Dean's comment because I wanted just to not answer the whole thing right now, but just to kind of prompt you for VantageScore. Dean, the answer to your question is absolutely yes, and used widely.
Yeah,
Um,
thousands of creditors. I think the last time um, there's a consulting firm called Oliver Wyman, and Oliver Wyman has done multiple market adoption studies of the VantageScore credit score. The last one I saw, which may have been a couple of years ago, but the last market adoption study that I saw that Oliver Wyman's not a person, it's a company. Oliver Wyman's most recent market adoption study indicated like thousands of creditors are using it, and like 12.8 billion of the scores were used during that 12-month period. So the answer to the question, which is, by the way, a very fair question, Dean,
yeah,
it's fair because the market adoption in the mortgage industry is zero. And so it suggests that, well, no one uses it because when I go apply for a mortgage, they use these FICO scores. But outside of mortgage, it's a very popular score. So,
right,
and by the way, within the next 18 to 24 months, every mortgage is going to have a Vantage score and a FICO score. So
right.
it's getting closer and closer to people. People can no longer call it a fake score or an educational score, or this website gives out a Vantage score and that's irrelevant. It's not really true.
Yeah.
So it's
Well,
actually a pretty interesting market adoption study. FICO was kind of the they were the only restaurant in town for decades, and so if you wanted to eat, you had to go to that restaurant. Well, then VantageScore builds a competing restaurant, and now you have people that are kind of picking and choosing which restaurant to go to. The FICO restaurant is still by far the most popular restaurant, but the VantageScore restaurant has a lot of customers,
yeah.
and so it's absolutely, we need to quit calling it anything other than a legitimate and valid credit score because it's ECOA compliant, it's FCRI compliant, it's used billion. When I say, I'm using the letter B, by the way, I'm not saying millions, I'm saying B with a boy. It's like the population of the Earth times 2 is the number of scores that were used the last time Oliver Wyman did one of these studies. And so
Oh, and to qualify that, John, too, that's not just gimme scores. Those are firm offer of credit scores that were provided. I
yeah,
mean, these are
you
these were
make an
decision making scores.
you make an interesting point because a lot of people come back with, well, yeah, but Credit Karma, that has to be mostly Credit Karma and Credit Sesame. No, it's not. If you look at the Oliver Wyman study, which is, by the way, it's public, you can just Google Oliver Wyman Vantage Score market adoption, and you can see all of the studies. They actually kind of break down where those scores are coming from, and the scores that are being given away, the free scores that are being given away, is actually a relatively small percentage of the whole.
Yep.
There's also another point that I want to make. We commonly refer to those as free scores. There is no
Free.
such thing as a free. There's no such thing as a free score. It's free
Yeah.
to the consumer, but I guarantee you that Credit Karma is buying it so that they can give it away.
Yeah.
And
Yeah.
so from
Yeah.
a
They
revenue
still.
perspective, it's still a revenue generating transaction.
Yeah, they figured out how to monetize that client, but they're paying some money for those scores. So, John, my contention has been, and let me know if you agree with this or not, that one of the reasons why there's a lot of confusion, just put aside the fact there's not a lot of credit education out here, consider why there is so much confusion. Would you agree that it's because initially scores were never meant for the general public to see? It wasn't. Credit scores and credit reports are really not for us, or weren't for us originally. It was a conversation and a relationship between credit bureaus and data furnishers for the purpose of credit. And it wasn't really until I saw you posted something the other day that I think it was the 30th anniversary of FACTA,
That's right.
and that's what gave us
20th.
20th. Sorry, yeah, 20th. So FACTA is what gave us one of the things we got from FACTA. That's the Fair and Accurate Credit Transaction Act. Was annualcreditreport.com. So
right.
that might have been where we started to really get thrust into, wow, now we have access to all this stuff. Before we had to pay money for it.
Yeah.
And now the general population is becoming more and more interested in their credit as it's been made available to them. But would you say that why there's a lot of confusion? Because for years, like you said, FICO since the 50s and Vantage Score being implemented, FICO Score being implemented into the bureaus in the late 80s, 89 specifically, that we went decades without ever really knowing much about our credit score.
Well, we aren't the customer,
Yeah,
right?
exactly. Yeah,
The bank is the customer. The collection agency is the customer. The credit union, the credit card issuer, the auto lender. And they're still the customer. We're still, if you look at the revenue generated, I mean, these companies are all public, right? Except for Experian, all the credit bureaus, FICO, they're all public. So, to the extent that you want to spend time digging through their earnings statements, the consumer is not driving the lion's share of the revenue for these companies. The lion's share of the revenue is being driven, especially in the scores, kind of vertical, if you will, is by borrowers, or excuse me, is by lenders, end users, what we call end users. So the banks, the credit unions, the credit card issuers. Sure, I mean, look, the consumer has become a customer, but by and large, it's still the banks and the debt debt collectors and the credit card issuers that are the customers. And so the credit report was not designed for consumer consumption. If for the people watching, if I showed you a credit report in its native format, meaning what does it actually look like without all of its makeup? It's just a series of it's a comma delimited string of alphanumeric characters. That's it. Remember the beginning of the Matrix, David, where the beginning of like all the characters are kind of falling and like the one dude can read and see what all that stuff actually means.
Right.
That's kind of what a credit report looks like. It's all this, it's letters and numbers divided by commas that to a layperson, it would make absolutely no sense.
Yeah, just gibberish, right?
It's gibberish. That's called Metro. That's the Metro language. That is the native format of a credit report. The credit score was not designed for consumer consumption. It was designed for use by lenders to assess the risk of doing business with me, you, anyone else who's watching this right now. There were some meaningful historical events that kind of prompted the discussion about making all of this stuff more consumer friendly and accessible to consumers. Ken Harney, who's now deceased, Ken Harney was a reporter for the Washington Post, and he wrote an article in the mid-90s about Fannie Mae and Freddie Mac forcing the mortgage industry to use FICO scores. And that kind of put FICO on the map, if you will, with respect to consumers. And you had FACTA. Obviously, you had FACTA from 20 years ago. For those of you who have been in the industry as long as we have, you may remember FACTA, which amended the Fair Credit Reporting Act and required the credit bureaus to give you one copy of your credit report every 12 months, as if that's sufficient. Again, politicians watching us, watching our back, one every 12 months, how woefully inadequate is that? And if you remember, it went West Coast to East Coast. The implementation started in California, and then the second quarter, it moved a little bit more to the east. In the third quarter, it moved a little bit more to the east. And in the end of the fourth quarter, it finished on the East Coast. And then it was nationwide. It has been for almost 20 years now. So that really was the beginning of the consumer becoming more knowledgeable about the credit reports because they could get it without having to buy it. They removed the barrier to entry of having to pay for it. And then you had some people who worked for, I think it was either mortgage reporting companies or mortgage brokers. They were just giving out scores to consumers. They were giving the credit reports and scores to consumers, which was a violation of their subscriber agreements with the credit bureaus. They got a lot of threats that they were going to get shut off if they kept doing it. But it got a lot of coverage. People got to see this number. They had no, what the hell is a 780 mean? Is 780 good? Is it bad? It's kind of some number, random number. I have no idea what this number actually means. and then boom, and then you have the internet kind of blowing up, and you have the, you know, freecreditreport.com, the consumerinfo.com. Remember the dudes living in their parents' basement working at the fast food restaurants, you know,
Oh yeah.
trying to prove their
Going
credit
back.
scores. Those commercials were epic. And then, you know, now you have God knows how many lenders giving away FICO scores. You have the websites, the freemium websites, and as long as you're willing to look at some ads from time to time, they'll give you summaries of your credit reports and your credit scores. You have the Fair Credit Reporting Act has been amended to make security freezes free. You have no shortage of companies that are willing to give you free single bureau monitoring services. So we've kind of evolved from nothing now almost to too much. And
Yeah, I was
so
gonna say it's an onslaught of information now.
I remember. I'm not going to identify the company, and I got to be careful here. I can remember the chief risk officer from a very well-known large lender, kind of giving me grief at an event that I was speaking at many years ago, and the grief was, "Why are you giving away credit scores to consumers? We don't want them to know how to
Right.
artificially improve. We don't want you to tell them pay off your
Yeah.
balance right before you apply for credit. We want people to manage their credit organically, like they normally do.
Right.
And
Yeah. Don't teach them how to game the system. Right.
that was the big concern. It was the gaming of the system. Right? You know, it's like when you come home and you've got a 9-year-old and you're sitting there watching them and they're acting like an angel, and then you turn your back on them and they're throwing food up against the wall. It's artificial performance. Would you rather them act naturally, or would you rather them act in such a way that's kind of pandering, that they're
Yeah.
pandering to what you want as a lender? And so he made a good point. And
It's a
the
good
point
point. Yeah.
it's a very good point. The point is that if someone's going to perform like a 700, then I want to see a 700 on their credit report. I don't want to see a 780 when last month it was 700, and the month after it's going to go back to a 700. But while I was underwriting a loan for them, it was a 780, and so now I've been kind of duped into assigning terms based on a misunderstanding of the risk.
Yeah. Yeah. And enter in Vantage Score 4 and FICO 10T. Now we're looking at trended data. So to me, using that kid example that you just gave, it's like having it's like going from the example to, well, now I got a little Ring camera inside my house and I can watch that little fool all day long and find out what he's been doing all day and the day before and the day before that. So now we have, or the mortgage industry at least, and I think this is a great move. I think them moving away from 20-plus-year-old FICO models to now adopting two different models, now giving Vantage Score its proper place and using trended data. Now we're really going to see what people do.
Yeah,
How do
so
they how do
it's
they
the
use their credit?
Truman Show of credit scores, right?
Yes,
It's the
right.
Truman. Everything there are no more secrets. So
Yeah, and
yeah,
if anybody, John, if you can give maybe like a 1 or 2 minute explanation of trended data, because people are like, they can probably figure out, well, trended data, okay, what do things look like? Uh, what does trending mean? But as far as credit reports and scores go rather, what does that mean, and why is that really significant now?
so the last time you pulled your credit reports, hopefully everyone watching has pulled their own credit reports many times. You've seen, especially for credit cards, you've seen what's referred to as trended data or time series data. It's the same thing. First off, it's why a lot of your credit reports, if you tried to print them, would be like 70 and 80 pages long. It's the previous 24 months of your balances, minimum payment requirements, and credit limits and whatnot on loans and credit cards. And so historically, before trended data, and trended data has been on credit reports for a long time, it hasn't been considered by tri-bureau credit scoring systems until Vantage Score 4 and FICO 10T. So now it matters, where prior to those scores, it kind of didn't matter. It was just there. So historically, if you looked at your credit, let's use credit card as the example. If I pull my credit report, which I actually did today, I can see what my balance is showing on that credit card, which is my balance from last month.
Right.
And I can see that it's being paid on time, and I can see what my minimum payment requirement is. And so I can see everything about it based on the most recent update from the card issuer. Well, if I page down a little bit, I can also see the prior 24 months of that information as well. So instead of looking at a very flat picture of my accounts, I can now take a little bit of a deeper dive and go 24 months into my different accounts. That's called trended data or time series data. That stuff is very, very predictive, meaning it has a lot of value in credit scoring systems. And VantageScore 4 was the first tri-bureau credit score to incorporate trended data, and FICO 10T was the first tri-bureau FICO score that incorporated trended data. And the FHFA liked it enough to say, you know what, let's go off these old models and boom, go right to the front of the line and use the most sophisticated models that are currently available, which is FICO 10T and VantageScore 4.
Yeah. So in other words, let's talk about one of the cheats that, oh, I don't know about a cheat, but it's gaming the system. It's the one guy that told you a long time ago, giving you a hard time for why you giving people scores. We don't want them to know what they are, and hence they'll be able to improve them. But one of the cheats, let's just say before you go into buy a home, go into the pre-qual process, or say buy a car. Well, I think it's not a secret now that everybody knows, okay, I got to go in, I got to pay off my credit card debt down as much as I possibly can. Let's just say I keep my credit card debt up pretty high. I'm a revolver, so I don't pay my credit card off every month. I just make a little bit more than the minimum payment. But now I'm trying to buy a home. Let me start paying that stuff down. Maybe I'll borrow some money. Family will give me some money or something like that, because I know that the lower that utilization is, most likely the higher the score. Well, what's going to happen now with trended data is now they can go back and see that you're not a transactor, meaning you don't charge your card up and then pay it off or pay it down. You keep your balances pretty high, and that's a different risk level than somebody who has the financial wherewithal that makes charges, whatever they are, on a monthly basis, but then pays it off every month. That's arguably a much lower risk individual. So that's largely what we're probably going to see with trended data. Do you think?
Yeah. So what I'm hearing, and what FICO has gone on the record and has told me, and they're okay with me sharing this, is that what's really important in trended data is the trajectory of your utilization.
Mm-hmm.
So are you, 80% utilized, 80% utilized, 1% utilized? Or are you 80% utilized, 70, 60, 40, 30, 20, 10, low, 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 low? So the trajectory, because now we have 24 months of your utilization, right? So
Yeah.
if you can actually do a little chart and track your utilization over time, where without trended data, you couldn't do that. You could just only see what your utilization was as of the date that you pulled the credit report. So that's really the big enchilada, which is the utilization. And so what does that mean? What does that mean, John? Well, what it means is for these newest scoring systems, the 10T and the VantageScore 4, yes, it's still very important to have low balances relative to your credit limits, but it's also very important that you get there and are there for a while, that you're not like heavily utilized. You sell some stock, pay off a credit card, and apply for a loan. Yeah. That may be great, but it's not going to be as effective as if you were paying down your cards over time and then maintaining low utilization ratios over time. Look, there's still ways to not, I don't want to call it cheat the system, fool the system. There's still what I call, appropriate and ethical ways to hack the system. That whole pay your credit cards by the statement closing date is still a fantastic strategy, regardless of what credit score is being used, because it prevents large balances from ever going under credit reports, even in the trended data. So that's that's still, in my mind, one of the most effective ways, if not
Yeah.
the most effective way to deal with credit card debt, because you still get to use your cards, you still get to earn rewards if that's your thing, you still get the protections of credit cards, which are pretty much ironclad. And if you don't need that 21-day grace period, if you're going to pay it off in full anyways, if I can just convince you to pay it off prior to your statement being sent to you, then the statement you're going to get is going to have a zero balance, and that's going to be what's reported to the credit bureaus. And so your utilization is going to be, I mean, pretty much de minimis, and everyone's going to be happy. And the only thing you did was you chose to focus on a date that was 21 days earlier than you were going to pay it in full anyways.
Yeah. Uh, Real quick, I just saw that Rick, I don't know if you're still here or not. How can consumers take advantage of the different FICO credit scores? Not sure. Not sure what you mean by that, Rick. What do you mean
Yeah, I'm
by
not sure what that means. Take advantage. I mean, what the one thing that's consistent across all of the FICO models and all of the Vantage Score models is the stuff that's important is still important, right? So the paying your bills on time, avoiding the negative stuff, the maintaining low balances and few balances. And by the way, I've had a couple of recent um, expert witness retentions where, man, oh man, some jackass expert on the plaintiff side really was trying to ride the installment debt horse, trying to really criticize, people that reported installment debt because they're, killing your credit. Installment debt is almost immaterial to your
right?
credit. You can have millions of dollars worth of installment debt and have elite FICO scores well into the 800s. It's not the installment debt, people. It's the revolving debt. If you look at installment debt, the default rate of installment debt is very, very low compared to the default rate of revolving debt. So because of that, they have a different risk profile, which means that they're going to drive credit scores differently. So
Well,
paying,
well,
in fact, it's not, and you've probably seen this, David, it's not uncommon that when you pay off an installment debt, your score goes down,
down a little
not
bit, yeah.
up. That never happens when you pay off credit card debt.
Right.
So if you're going to focus on debt, first off, focus on the expensive debt, which is credit card debt, and B, focus on the debt that really will yield an improvement in your score, which is the revolving debt. Don't focus on the installment debt.
Yeah, installment debt is a different animal. It's usually collateralized debt. You've normally got something that there's risk there, that something that could be taken away, a car, a home, a boat, a plane, or whatever. For all people who have boats and planes, not me. But yeah, installment debt, not a big deal. But my bigger question is how does somebody get to be an expert on the plaintiff side and think that installment debt is heavily weighted in scoring? How does that happen?
It's very simple, David.
Where do they dig up that person?
There's no shortage of people who will say whatever the hell you want them to say for $500 an hour. There's no shortage of people who are willing to do that. So that's why there's people like me who point out that that's wrong, and then a jury gets to decide who they believe and who's more credible, and that's how.
Right. Yeah, Rick, if you have an expansion on your question, maybe just specify what you mean by that. We're more than happy to answer it in the maybe 5.5, maybe 10 minutes at the most that we're going to be on here. Before we wrap up, I see that we have a little over a dozen people watching. If you have any questions, shoot them our way. Even if they're not related to credit scores, we'll do our best to answer them for you. John, we talked about FICO quite a bit. We were going to go into Vantage Score. Did you want to launch into Vantage Score a little bit?
Yeah. I mean, it's been around since, so this is the 17th year. So it's not a new score. It's the 17th year of the Vantage Score. It's been around since 2006. They're on their fourth generation. So there's Vantage Score 1, 2, 3, and 4. The score that's given away, so FICO's done a really good job of kind of becoming also very relevant in the free score world. So most of the scores that are given away by lenders are FICO scores. And you'll, if they're branded FICO, they're FICO. If they're not branded FICO, they're probably Vantage scores. That's the one thing that none of these, you're not allowed to misbrand the score that's being given away. So you'll never see someone giving away a Vantage score, but then saying it's a FICO score, or vice versa.
Right.
So look for the branding in the fine print, and you'll know what kind of credit score is being given away. So Vantage score is really kind of the first credit scoring system that was widely given away to consumers at no cost. And FICO has done a really good job through their open access programs with lenders of becoming equally relevant in that particular space. The challenge with Vantage Score, which they worked very hard for many, many years to overcome, was this issue with the FHFA, because FHFA is they're basically the gatekeeper with respect to what credit scores can Fannie and Freddie use in desktop underwriter and loan prospector, meaning mortgage lending. So it was because of FHFA that they kind of froze out the newer versions of the FICO score, all versions of the Vantage score, and all versions of every other credit score that has been built. And so the model actually grew in popularity outside of the mortgage world, but it's only in the mortgage world where you get things like credit score disclosure notices, and maybe your lender even gives you the tri-merge report, and none of those have Vantage scores. They all have FICO scores. So the presumption, kind of to Dean's question, which is a very common question, is, well, who cares? No one uses it. Well, that's true, but only in the mortgage world. But the mortgage world makes up a very, very small percentage of the credit transactions. Think of how often you apply for credit cards and auto loans relative to how often you apply for mortgage loans.
Yeah.
You apply for cards and cars in aggregate way more often than you buy houses, right? So the number of transactions that are non-mortgage transactions is considerably high. Think of all the pre-screened offers you get in the mail. Literally billions and billions of those things are sent every year. There's only 300 million people in the U.S. and only 220 million have credit reports. But still, you get repeat offers from the same card issuers. Those are all based off of the quality of your FICO scores. So the volume is still really in FICO's corner, but Vantage Score has done a very, very good job. Look, it's almost like Microsoft, or it's almost like PC and Mac, right? So PC is still, the Windows operating systems versus the iOS, the Mac operating systems. It's not that bad to be the second most commonly used right? You see what I'm saying? It's not like one party has 100% market share and the other one has 0% market share. In the credit score world, even having 20 or 30% of the market share is still really, really meaningful, considering the massive amount of scores that are calculated every single year.
Well, so John, when we were at a last Credit Con, one of the I think you asked this of I forgot the gentleman's name from the CDIA, but I believe he said that there was roughly 15,000 data furnishers. Is that right?
14.
So 14,000 data furnishers, and as you said, a couple thousand of them routinely use Vantage Score in their lending decisions. So that's a big chunk. You can't dismiss Vantage Score when you hear numbers like that.
Yeah. Well, you can dismiss it at your own peril, because your Vantage Score and your FICO scores are not going to be the same. It's like Pepsi and Coke. They're the same thing, but they don't taste the same, right? People have preferences. I'm a Coke guy, and I'm a Pepsi guy. You can't really ignore one just because you don't care about it. You should become knowledgeable about both. So if you are ever in a scenario where you want to apply for a mortgage loan in the next couple of years, the lender's going to get both. So it seems to make sense to me anyways to not just focus on improving one of your brands of scores, but to improve both of your brands of scores.
Yeah, and again, all that comes back just specifically, all the scores are going to come from the data on your credit report. So now that we have trended data, keeping mindful of, I think anyway, just from what I've read, that your utilization rate is going to play one of the bigger roles in what your score is. So if you're one of those people that is a transactor and you tend to pay your credit card debt off, or you're going this way in your credit card debt, you might see an uptick in your score. If you're the other way around, and you might see a little drop. Who knows? We'll discover this together in a couple of years for those who are going to be buying homes.
The advice that, whenever I do media interviews and so, how can people improve their scores? How soon should people check their credit if they're interested in buying a home, or how far in advance should people check their credit? People traditionally have said, a couple of months, and if you see anything wrong, it'll give you some time to deal with it with the credit bureaus. I'm not sure that's the right advice anymore. If you've got really, really good credit scores, lather, rinse, repeat, and don't worry about it. But if you've got credit scores that are kind of right along the edge of what's called a risk tier, so like the 620, the 650, the 680, those are meaningful score ranges, because if you can get above those, you're falling into a better risk tier for mortgage lending, and you're going to get a better deal from them. So those are meaning. If you're at 810, you could put me on mute for the next couple of minutes. But if you're in the 620s and 650s and 680s, this is really important for you. You don't wait till a month before you apply for a mortgage loan to pay down your credit card debt, because with trended data, you're not fooling anybody, right? Because we'll be back 24 months. So you can't tell people, 2 months before you apply, you should pull your credit reports. If you really think you're going to apply for a loan in the next 2 years, you should start looking at your credit card debt now.
Exactly.
And start chipping away, because then you're showing these models that your trajectory of debt is going like this, and that's really important to them, where in the past, it hasn't been important to them. So we kind of have to rework how we think about this a little bit, to the extent that you want to really kind of squeeze every possible point out of your credit reports.
Yeah, this will be a big area of education. All right, John, we are coming to the end, about 45 minutes, maybe a little bit more. So thank you again for joining me today. Everybody watching, if you're watching this on a replay and didn't make it live, if you have comments, just leave them below. We'll swing back around and answer them for you. Thank you very much for joining me today. John, thanks again, and we'll be back next Wednesday. Take care.
Thanks, David. See you later.